Adjustable rate mortgages for the national portion of the real estate exam are loans where the interest rate can change at specific intervals, which distinguishes them from standard fixed-rate mortgages. To master this concept for the test, you must understand that the interest rate is composed of two distinct parts, which are the index and the margin. The index is the economic indicator that the lender uses to track changes in interest rates across the broader market. Common examples on the exam include the Secured Overnight Financing Rate or the 11th District Cost of Funds Index. It is vital to remember that the index is the moving part of the equation and is completely outside the control of the lender. The second component is the margin. This is a fixed percentage point added to the index by the lender. The margin covers the lender's operating costs and includes their profit. On the exam, a frequent trick is to suggest that the margin fluctuates with the market. Do not fall for this. The margin is set at the beginning of the loan and stays the same for the entire term. When you add the current index to the fixed margin, you get the fully indexed rate. If a question asks what determines the interest rate movement, the answer is the index, not the margin. The structure of these loans, such as the 5-1 ARM, is another critical area. In this scenario, the first number represents the initial period during which the interest rate remains fixed. For 5 years, the borrower has the stability of a fixed payment. The second number indicates how often the rate will adjust after that initial period ends. In a 5-1 ARM, the rate adjusts every 1 year after the first 5 years have passed. Exam questions may try to confuse you by asking if the rate can change monthly in a 5-1 ARM. But the correct answer is that it adjusts annually after the 5th year. To prevent borrowers from facing massive increases in their monthly payments, ARMs include interest rate caps. These caps are essentially a safety net. The initial adjustment cap limits how much the interest rate can increase the very first time it resets. The periodic adjustment cap limits how much the rate can increase from one period to the next, such as from year 6 to year 7. Finally, the lifetime cap is the most important for the borrower because it sets a maximum ceiling on the interest rate for the entire life of the loan. If the initial rate is 4% and the lifetime cap is 6%, the highest the interest rate could ever reach is 10%. A common exam trap involves the concept of negative amortization. This occurs when an ARM has a payment cap that is lower than the interest rate increase. If the monthly payment is not enough to cover the interest due, that unpaid interest is added to the principal balance of the loan. This means the borrower owes more money at the end of the month than they did at the beginning. You should associate negative amortization with high-risk scenarios and older loan products. One memorable phrase to help you remember the ARM components is that the index is the indicator and the margin is the markup. The indicator moves with the market, while the markup stays the same. Lenders are mandated by the Truth in Lending Act to provide the Consumer Handbook on adjustable rate mortgages, often called the CHARM booklet, to any borrower considering an ARM. This ensures the borrower is fully aware of how their payments could change. If a question asks which type of loan is most likely to cause payment shock, the answer is an ARM because the fluctuating interest rate can lead to significant jumps in the monthly obligation. Always look for the relationship between the index, the margin, and the caps when solving math problems related to these mortgages.